Welcome to our second annual FinTech Conference at Stern. I'm Raghu Sundaram. I'm the Vice Dean of MBA Programs and Online Learning at Stern. And it gives me very special pleasure to welcome all of you this morning. I apologize for the somewhat early start, but we have a packed and excellent agenda. Hopefully that will make up for getting you here somewhat early. Just a few words of introduction before I turn the mic over. As many of you know, Stern has one of the largest and certainly one of the strongest finance departments of any academic institution in the world, a fact of which we are inordinately proud. What is less well known is that Stern also has one of the largest and one of the finest collection of data scientists and computer scientists of any business school in the US. And it was a natural for us to bring these two groups together and start what was the first fintech specialization of any business school in the US, something we did a year and a half ago. Already before then, we'd started offering a number of courses in what is now called fintech. In 2014, Stern became the first business school to offer a course in blockchain. And before that, we already had courses in robo-advising and a few other areas. And now all of those have collectively come together into a formal specialization at Stern. It's odd to think of very large institutions being nimble, but one of the things that enables Stern to be nimble in moving to market conditions is precisely our size. We have a range of faculty, we have a range of specializations, and when market trends change, we were able to adapt very quickly to it and move into offering a fintech specialization. This conference, the courses we offer, everything else is a small part of that, of our activities in fintech, and we are aware that we are at the start of what promises to be an extremely exciting journey ahead of us, where we are bringing fields together and staying ahead of trends that are happening in industry. So before I turn the mic over, there are three groups of people I would particularly like to thank for enabling today's events. First of all, our sponsors, Broadhaven, Evolute, EquityZen, First Data, S&P, and TrueMid. Thank you all for your support. Second, to my faculty colleagues who came together to put this conference together. Most of all, to Kathleen DeRose. Kathleen is an alumna of Stern. She joined us after a successful career in industry of just over a year and a half ago. She's brought in an unusual degree of energy and leadership into the program. And she's primarily responsible for putting this conference together today. So a very special thanks to all of you, and particularly to Kathleen. And third, to our fantastic administrative staff who came together in a coordinated fashion to make this possible. So thank you all again.
So hi, everybody, and welcome. We're absolutely thrilled to have you here. And just so you know, we have guests from all over the world, China, Switzerland, the UK, and India. So for those of you who traveled to get here, I think that's just amazing. And we're so excited about this conference because I think of all the conferences in New York around the world, this is one of the first and only that actually mixes academic insights with industry participation, with regulators who are going to be visiting us here, and we even have a fintech nonprofit. So that's pretty cool and amazing. So I think you're going to have a fantastic day. It is super packed. And I do want to just take the moment to share with you our ambitions in fintech. As Raghu mentioned, we have the first and only FinTech MBA, which we've now extended to undergrads and consists of a foundational course and 10 really cool electives. Secondly, we actually want to be and aspire to be thought leaders in fintech research. We think that the data that's coming out of these companies is really going to shape our understanding of financial behavior and also help us reshape policy. So that's super exciting. We're actively conducting research partnerships with industry today. And then lastly, events like this are deliberate intentions of ours to really be a big part of the fintech community here in New York. New York is a very special place full of innovation, and we're super excited to be a part of it. I just want to mention a couple logistical details for you guys. So first of all, Yahoo Finance is streaming 3 of the sessions today, and there is press in the room, and everything's recorded. So just keep that in mind. And we all know what that's like. And then secondly, just one logistical thing. I want to explain the way the lunchtime brain dates are going to work. So on your name tag is your room number. And if it says UC, that's on this floor. And if it says LC, that's on the floor immediately below. The rooms are arranged like a giant horseshoe around this conference room right here, this auditorium. There are 2 rooms that are not on these 2 floors. Ken's show is on the lobby floor upstairs. And Dream Forward Financial is in our Commons room, which is in the building next door. If you need help finding anything, we have an amazing group of volunteers here. They're wearing purple T-shirts that say volunteer on them, so you can find them, and they can help you navigate. But they are quite easy to find. I'll remind you again over lunchtime. And those brain dates are really cool because you're going to get a chance to deep dive with companies and around topics and have a really cool conversation. So I hope you enjoy them. The way the logistics are going to work is you're going to go pick up a box lunch and then head to your room. And it looks like you have a lot of time for that, but in fact, I think by the time we get everybody out there, fed, and in the right room, it will consume a good chunk of that hour and a half or so that we've allocated to that. So do go to the room assigned. Each room is really at capacity, so just out of respect for those guys, if you'd stay in the assigned room. So that's the logistics. Any questions? There's lots of people around to help. It's going to be an amazing day, and we're going to kick it off actually with one of the kind of leading lights of fintech investing here in New York, and that's Matt Harris of Bain Capital Ventures. So I'd like to turn it over to him now.
Thank you. Hi, everybody. I'm Matt Harris. I'm an investor with Bain Capital Ventures. And I'm going to introduce myself in a little bit more detail and talk about what I've done, but really spend the bulk of the 20 minutes I have scheduled to talk on the history of investing in financial technology, and then talk in a little more depth about some of the sectors and how we look at things and try to be provocative around some of the frameworks we use. We're going to try to save 5 or 10 minutes at the end for Q&A. It's ambitious. We're packing a lot into 25, 30 minutes, but if you have questions, hopefully there'll be time at the end to chat through them. But I'm going to skip ahead a bunch of slides to talk about history. Here you go. This slide, by the way, I used to work at Bain & Company, and now I work at Bain Capital, so there's lots of slides in my life, lots of charts and graphs. I apologize up front for that. This, to me, is sort of like the story of my professional career, in a way. I started at Bain & Company in the early 90s. I was at Bain Capital for most of the kind of mid-90s, and then I left to start my own firm at the height of the dot-com boom, basically, a firm called Village Ventures. And we didn't really have a game plan, or we had a game plan that we had to throw out the window pretty quickly when the world really changed on us, and venture capital was really in the tank in post-dot-com bust, and people were skeptical about the idea of innovation and technology. But we had this firm, my college roommate and I started, so we had to do something with it. And I went away with my golden retriever for a long weekend and thought about what I was going to do. And I decided financial technology. This is at the far left side of this graph in 2001. And the observation was that there was effectively zero venture capital, rounds to zero venture capital in financial technology. And what there was investing in vendors, mainly capital markets focused vendors. Software companies, typically on-premise, big iron software for broker-dealers and investment banks, which is not what I was interested in. And so from the way I define fintech, which I'll get into in a second, there was literally nothing going on. And so I decided to make my career about financial technology. And I did not predict what would happen on this chart. It was not a bet on fintech per se. It was just a recognition that if you're going to make a living as an investor, I think the smart thing to do is to be the leader in something. And whether that's geographic, whether that's an industry vertical, whether that's just a style of investing, to be known as the person to talk to about anything, even if that thing remains obscure, I think is a better strategy than trying to hitch your wagon to an extremely sort of already consensus star. At least that was my approach. And so I had sort of resigned myself to a life of obscurity, in fact. You could see that those bars stayed pretty low for a long time. And the venture business had bounced back. I mean, the venture business did collectively shrink in 01, 02, 03, but it started ripping again in 4, 5, 6, 7. Not so much fintech. And I remember I had all these conversations with my wife about how boring what I did was. And we'd be at like cocktail parties, and she'd be like, you don't talk so much about work. How about that? Let's just, but it was a field of endeavor that lent itself to expertise. It's complicated, fintech. Not only is it complicated, but it's wildly diverse. Like if anyone can explain to me what an insurance company has to do with a merchant acquiring payments company, I'd love to hear it. Those two things have nothing to do with each other. And yet, we all talk about them very facilely as part of FinTech. So I felt like I had a lot of wood to chop just getting smart about the space that I said I was supposed to be an expert in. But then something very serendipitous happened. You can see it a little bit in the chart in 2010, which was it all due to a glassblower in St. Louis. This is when I think about why FinTech became what it became. I think about this glassblower in St. Louis who was selling these beautiful pieces that cost $300, $400, $500. And what he found was that the average person is not carrying $500 of cash, even when they're going to visit his studio. He was selling direct out of his studio, and nobody was carrying a checkbook. And so he was losing sales all the time because of this problem of he couldn't get a merchant account. There was no, Chase Payment Tech or Global Payments or Vantiv or Elevon, they were not looking for the sole proprietor glassblower as a merchant. Nobody was setting out to enable him to take credit and debit card payments. And he happened to have grown up with a guy named Jack Dorsey in St. Louis, who had just been fired from Twitter. And they were talking about this problem, and Jack Dorsey, one of the, at the time, and I think still, coolest, hippest entrepreneurs in the Valley, hears this problem and says, I don't know why we can't solve that. That seems like a technology problem and a risk management problem and all things that can be solved through analytics and computers. Why don't we get to work on that? And when that company, which became Square, was announced, there was this seminal moment in the Valley where every other entrepreneur said, if Jack Dorsey thinks payments are cool, maybe there's something to do there. Maybe that is actually something worthy of my attention. And engineers started thinking about payments problems for the first time, like the best engineers saying, well, maybe merchant payments is going to be Square's things, but there are other problems within payments that we can work on. And when you have engineers and the best entrepreneurs doing something, then venture capitalists get very interested. And so, as much as anything, people also point to the global financial crisis and the fact that banks all of a sudden seemed vulnerable. But to me, it was that glassblower in St. Louis leading to one of the top most famous entrepreneurs in the country declaring FinTech is as inbounds for entrepreneurship. And as we sit here later, we don't have 2017, but it will be up from 2016 meaningfully. We can talk about the composition of that. FinTech has become, give or take 10% of the venture business, up from 1% or so. And we sit here today with 400 people who are interested in talking about it very early on a Friday morning. So we've come a long way, and I can talk a little bit more detail about how that happened and maybe a little bit about where we go from here. But this slide both talks to the history of my career. So when that all happened, I decided to go back to Bain Capital. My firm had a couple $100 million under management. The opportunity, as you can see here, became very significant. And so at Bain Capital, I have the luxury of investing as much as $100 million in a single company, but still the ability to invest less than $1 million in a seed team. And that's the luxury that I really need to do my practice, which is about developing a thesis and then going out and trying to meet the best people who are working on those problems. And they're going to be at whatever stage they're going to be. And so I needed to be in a platform where I could fund them wherever they were. And that's the luxury I have at Bain. So let me go back a little bit. So this is us. We are about $4 billion as a component of a $70-odd billion asset management firm called Bain Capital, primarily known for private equity, massive credit operation. We also do public equity. We have our own fund, our own team. We kind of share a brand name and a bunch of cultural identity. But it's been a great, as I said, great platform for me because of the mandate, so broad, and because the brand is relatively well known, particularly amongst financial services firms. So there's a kind of a credibility there that I've enjoyed. We've done well, blah, blah, blah. All right, back to FinTech. As mentioned, it was small, it got big. And again, even as the venture industry grew, by 2010, it was still only 2%. So the massive spike happened more recently than that and continues to happen. This is a bit of an eye chart. But it's a good context for me to talk about the segments of FinTech as I see them. And by the way, these materials will all be available, so don't feel the need to memorize any of this. You'll have them in your inbox if you want them. So the first thing that happened was payments, for sure, as mentioned. Started with merchant payments, moved then quickly to mobile wallets, and basically that whole consumer retailer transaction. First, again, micro merchants, then all in-store, peer-to-peer, card not present, which is the payments transaction in an e-commerce context when you aren't physically there with a card. This became, the sort of multifaceted battlefront for entrepreneurs to take on incumbents. And this, by contrast, as I mentioned, to those capital markets-focused software companies 17 years ago, the modern version of fintech, particularly in its early innings, was about not serving banks, not even particularly where possible partnering with banks, but rather beating banks. It was a sort of radically insurgent movement that basically had at its core this idea that banks are terrible. Most of these companies explicitly or implicitly were saying that to customers of all types, you have been failed by banks. You have been taken advantage of by banks. And when I say banks, I mean all incumbents, broker-dealers, carriers, insurance brokers, the whole panoply of existing vendors basically got thrown under the bus. And it started in payments, again, on the issuer side, so the consumer card payments, but also the merchant side. And it started in payments for a number of reasons, glassblower anecdote notwithstanding, as a component of that. But really, payments had left the banks long ago. If you go back to the mid-90s, banks had 90+% market share of payments. If you fast forward to well before the fintech revolution, they were down to 40% market share. Banks at various times had realized that merchant payments was a scale business, and in many cases had cooperated with companies like First Data, one of our sponsors here today, and really one of the original fintech companies, and a fantastic company at that, in my view, under its current leadership, I should say. They had already capitulated. This was acknowledged to be tech-driven, scale-driven, data-intensive, and banks had more or less said, you know what, we're not great at those things. We're great at other things, perhaps, but not that. And so it was a natural sort of easy wedge for entrepreneurs to already say, okay, there are acknowledged models for non-banks, non-incumbent, non-FIs to delight customers in payments. And so that was, in a sense, the easy part. It got much harder in the second facet of this, which was lending. There has been specialty finance forever. There has been non-bank alternative finance, for hundreds of years. It's always been extremely hard. It has never been something any venture capitalist in the world would ever fund, because every dollar of lending means some amount of money of equity. That has been the historical model. Is if you want to make loans for a living, your cost of goods sold is money. You got to have money coming in fast and furious in ever more amounts to lend it out. And generally speaking, people won't just give you money to lend. Generally speaking, they want you to have some skin in the game. That is sort of certainly the arc of history. And so for venture capitalists, it's like this, historically in the sort of normal phase of venture capital where capital is dear, a lending company seemed like a terrible idea, just infinitely capital intensive. And the more it grew, the more capital it needed. That's like a bad equation for a VC in general. But a bunch of things happened in 2010, 2011 to reverse some of those historical trends. One was that the banks, in fact, had retreated from a bunch of different lending categories. So there was legitimately a market opportunity for a period of time. Two, there was no yield in the global economy. And so those purveyors of capital, for a short period of time, in retrospect, were willing to lend money without the originator having skin in the game. Again, this marketplace lending or peer-to-peer was not an invention. It's called whole loan sales. That was the funding mechanism of marketplace lenders, was you originate a loan and you sell it. Not like a new concept, a very well-branded new version of an old concept. But for once, there were people at scale being willing to participate in funding through whole loan sales without requiring the originator to have skin in the game, because there was no yield anywhere else. And then we were in an extremely benign credit environment. And so this, the first category of loans that we were attacked was unsecured personal loans. This is the classic lending club loan. Ask any banker, and they will say, yeah, that's a really terrible product. That is you can do underwriting all you want, but what matters in a crisis is what's called payment priority. Where do you get paid when a consumer is under stress? Where are you in that stack? Unsecured personal loans are at the bottom of that stack. You're going to pay your house. You're going to pay your car. You're going to pay your credit card. You're going to pay your student loan. And then if you have any money left, you're going to pay that thing from, what is that, club place? That's not even a bank. I'm not paying that. So this was, like, in my mind, like a moment of lunacy, honestly. And I have a sort of dark view of lending in particular. But like the idea that it also coincided with a time when the venture asset class had more money than it really has ever had. There were new entrants, hedge funds and others, getting into venture capital, and they had gobs of money. And you know what the thing of a venture capitalist? We get paid to raise and invest money in a linear way with the amount of money. More money, we get paid more. And so the incentive is to raise more if you can find a place to invest it. And lending presented itself as this incredible opportunity. What had historically been a negative, requires equity capital, became a positive. You could raise equity, put it into lending companies, and they always need more. It's brilliant. Let's just keep this thing going. It's like the star-off machine on the Sneetches. Like, we just kept running the lending companies through the equity machine, and people kept raising more and putting it. And then the music has more or less stopped. So lending went from like $7 billion a year of venture capital to maybe this year it'll be $1 billion. And it's really now down to the parts of lending that truly are tech-enabled. I would say the vast majority of lending venture capital now is in some version of point-of-sale lending. So these are loans like whether it be Green Sky in construction or a firm in e-commerce or bread or solar loans. These are transactional loans. You have to be highly integrated and tech savvy to make that loan. So you've got to be at the point of purchase. That to me, there's a whole framework around where does lending make sense for non-banks. But surely those very tech-enabled categories of transactional loans are places where banks generally can't play, and so therefore totally, sort of in scope for entrepreneurs, notwithstanding the fact that lending companies, when you compare them to other, more tech companies, are worse in every way. Which is to say, it's like a tech company, except it has credit risk, liquidity risk, and regulatory risk. And so to me, you look at a $100 million revenue business that was like a SaaS company, and you look at one that was a lending company, and you would value the second one at like an eighth what you value the first one, something like that. And there was a moment in time in 2015 when that was inverted. And there were all these SaaS companies like, how do I add lending to my business model? Like, what? So anyway, enough about lending. But so lending has tapered. It will continue to taper. And I think we will look back and say, well, that was really an amazing chapter, where we all thought that made sense for 6-7% of the whole venture business to be investing in lending companies. What came next, sort of simultaneously, but a little bit later, was investing. There's a number of companies here today, great companies in this space, Trizic, Marstone. But the whole capital markets, whether it be wealth management, asset management, trading around brokerage or exchanges or trading tools, information underlying capital markets, retail, wholesale, it's a wildly multifaceted opportunity to use technology to change all of that. We talk most about the consumer companies. We've heard of Betterment, Wealthfront, Robinhood. We have a company called Acorns, a company called SigFig. These are the names you hear, but there are dozens and dozens, hundreds really, of entrepreneurs doing very interesting things that are more wholesale in nature, designed to serve and enable existing participants in partnership. So we continue to be very excited about that. It doesn't have a mainstream appeal in many cases because it's very hard to understand. As an investor, you do just back great teams, kind of whatever they're doing is a good mantra, but it is useful if you know a little bit about what they're doing. And to know a little bit about what a capital markets infrastructure company is doing requires lots of study. And so it's part of the reason I'm drawn to it is that, again, because of the 10 years in the wilderness doing fintech when other people weren't, I know a little bit about it and more than the next venture capitalist. But it is, hard if you're a generalist to say like, okay, I'm going to go fund IEX, which is one of our companies. It's a, U.S. equities exchange, a wildly controversial company in many quarters. But, you have to know something about market structure in order to take a punt on that. And most people aren't in a position to do that. So capital markets will always be interesting, will always be, I think, capital constrained. And then, so payments starts to taper because the opportunity set is now perceived to be very competitive. And that's correct. Apple and Facebook and Amazon are all major players in payments. Stripe and Square and PayPal, Braintree, Venmo, these are big, big companies. And between them have kind of comprehensively done some crowding out of the open space in payments. So new investments in payments have tapered. New investments in lending have cratered at this point. Capital markets is sort of flat, I think stably flat. And what's taken up the airspace, what's kept us growing as a category is insurance primarily. That's sort of like what's happening right now in FinTech is, and I'll go into some of the sort of segments of InsurTech as they call it, but it is definitely capturing the imagination that you have, again, this $700 billion worth of premium in the United States alone across a bunch of different categories, whereas a lot of profit pool in there from capital markets to reinsurance to carriers to agents to brokers, where it's really crying out for disruption is the perception, and I agree with that. I think there's lots to do there. What's coming next and what's earlier on, I would say, what people variously call prop tech or just real estate tech is in kind of the second inning. But again, massive profit pools to go after between commercial and residential real estate transactions and management, and some great entrepreneurs. And it's also a very interesting New York space. One of the reasons I like FinTech is that New York can legitimately win in FinTech, surely in capital markets, surely in prop tech, extremely valid in insurance, not dominant, but legitimate. A bit less so in payments and lending. Silicon Valley sort of has claim to probably the dominant companies in that space, but we're rotating into our wheelhouse when we start talking about real estate, capital markets, and insurance. And then the final thing that's worth some focus, of course, is the whole crypto space, which you could argue cuts across everything we've said if you think about crypto as an infrastructure, or more narrowly, frankly, interesting in its own right, just as this novel store of value. And we can talk a little bit about that later in the presentation. But there's been $2 billion invested in crypto companies outside of the venture capital ecosystem through initial coin offerings. So if FinTech funding will be $15 billion this year, by the end of the year, I expect $3.5 to $4 billion of additional FinTech funding where I don't get a cut of the action, where it's this more democratic retail process, which is incredibly thrilling, and then, of course, people will go to jail. So we can talk more about that later, but let me cover some more of these slides. So again, as another dynamic is because unlike, for instance, the auto industry or the consumer packaged goods industry or many of the other, or transportation or hospitality, or many of the other verticals that are currently getting sort of besieged by technology, the incumbents in financial services feel very comfortable investing money. And so they have been extremely vigorously investing money. That number is up meaningfully this year. And so if you're a FinTech entrepreneur these days, one of the first ports of call are the many, many strategic investors in every one of those sectors, the banks, the broker-dealers, the insurance companies. If you want to raise money for any insurance-related idea, just go talk to Munich Re. They will do, it appears, a vast, I won't say they'll do anything, but they are interested in funding a vast array of things. And all of their competitors in the reinsurance and indeed the carrier space are similarly and relatedly interested. So strategic funding will, as perhaps some more generalist VCs retreat from the field, licking their wounds from that whole lending debacle, I think strategic funding will fill that gap and then some. Exits have been anemic. I mean, if you look at the average values, this is where at very least you have to say to yourself, the future has to look different than the past for this to have been a good idea. Which is not like the most comforting statement in capitalism, because there has not proven to be that much appetite to buy all of these unicorn-type companies that are being created in FinTech, particularly in the US. You can talk about China is a very different story, India is a very different story, but in the US, another one of the issues with lending is that unfortunately, nobody wants to buy a lending company except a bank. That's really the only, like, it's not like Adobe and SAP and Oracle wake up in the morning and say, geez, I really wish I had balance sheet risk in my business. They do know better than that. And so the only people who want balance sheet risk are those who already have it, i.e. banks. And to this day, the US government owns the equity capital of all the banks. They're not allowed to do multi-billion-dollar money-losing acquisitions. So there's just no way that there was going to have to be IPOs, and we've seen how that's gone for Lending Club and On Deck. So another reason that fintech in general has a bit of a problem, and specifically those balance sheet intensive companies, are that the buyers trade on book value multiples and are wildly conservative and heavily regulated. And so you have to believe in a bunch of independent companies that go public to create liquidity. And again, we haven't seen that yet. Let's talk about, so just what we've done. Thematically, upper left-hand corner, I love payments. It's sort of my first love. Wife and kids notwithstanding. But this merchant payments transaction is not that interesting to me. What I'm interested in is commercial payments. I'll talk a little bit more about it. But if you were to boil down my payments thesis in a phrase, it would be find paper checks and kill them. And paper checks have already been vanquished in the merchant transaction. That's done. The idea of like digital payments, like Visa and MasterCard are digital payments companies. There's not like the chunk thing that goes on anymore. Like it's all been eradicated. But in commercial payments, 50% of US B2B payments are still paper checks. It's an enormous multi-trillion-dollar problem. And so I've invested, let's just say this better work out. Because there's like a huge concentration of my portfolio in the idea that commercial payments will rotate into favor and people will get very interested in solving this problem. Capital markets, if there's a sentence there, it is basically the view that over time, most of the participants in capital markets and investing have made money through information asymmetry and opacity, which is to say, if they know more than their customer, they can monetize that relationship. It's been wildly adversarial. Notwithstanding all the friendly, fuzzy branding and what have you, it has been adversarial in every dimension of it. And I don't think that's sustainable. I mean, it's not like we're all better people than we used to be. It's just information is more transparent. I don't think you can be systematically taking advantage of your customers, which is the proud tradition of all those companies whose names I won't say. And so they got to figure out how to fix it. And there are going to be competitors to those people who do fix it. And we are all going to benefit from that. It will probably destroy profits. It will definitely destroy profits. But it will also reallocate those profits to new companies versus old companies. We'll talk about insurance in a little more detail. And we've got a couple other things that we've done that are interesting. So commercial payments, simply it's accounts payable and accounts receivable. It's big, medium, and small, and a bunch of infrastructure stuff. So we've, again, invested heavily on the AP side in different types of companies. Heavily, but really just in one major investment in Billtrust on the accounts receivable side. And then in cross-border, a company called Flywire. This is our sort of capital markets, simplified framework where you have the buy side, retail and institutional, and the value chain through to the transaction, and then obviously the other end of that. We have companies across this spectrum from SigFig and the advice side to Granite Shares, which is an ETF issuer that we funded. And we do weird stuff like that. Like my view is that ETFs are huge and startups aren't focused on creating ETF issuers. I don't know why that is. Like there should be more entrepreneurship in that, even though it's an oligopoly, because the net flows are so attractive on an annual basis that we have to back people to go after that pie. So that's the sort of thing we do. We believe in transaction marketplaces. We think they're very rare. Almost every marketplace company is a broker of some sort. And so we have a fine-tooth focus on parsing the brokers from the marketplaces, and we've made 2 bets there, as well as a number of infrastructure bets. And then finally, insurance. I won't go into this in detail because I do want to leave a minute for questions, sorry. So we have, there's 3 types of insurance, basically, health, wealth, and property casualty. You can be a bunch of different things on the value chain. You can serve a bunch of different types of customers. And then again, these horizontal segments here are sort of the infrastructure aspects. So if you think about the InsurTech universe, you could array all the companies on this chart. We've made 3. We had a company called SquareTrade that Allstate bought earlier this year for $1.4 billion. That was effectively a point-of-sale warranty company. a sort of specialized type of insurance. We have a company in New York called JustWorks, one of my favorite companies. It's what's called a PEO. So for smaller companies with sub 100 employees, they can get their health insurance and benefits from a broker, and they get treated like a small company, or they can go to a PEO and basically collectively get, with all the other customers of that PEO, a collective large company price for their benefits and other aspects of sort of the HR stack. JustWorks is, again, a New York company that has done extremely well in that category, focused on SMBs. And then finally, Corvus is a raw startup that we seed funded earlier this year, along with an entrepreneur, bringing novel technologies to large commercial markets like marine insurance, where we think about, with sensor penetration now being nearly comprehensive, how can we think differently about things like cargo insurance? So that's been really fun to work on. And then we have the other notable investments. Let me see. Are there one or two questions that I can answer in the short period of time?
Please go to the mics if you do, and we'll just take 2 questions.
2 questions, all right.
Because we're recording, so you have to go to line up behind one of these mics.
Makes sense.
Matt, you talked about the information asymmetry in capital markets.
Yeah.
The same kind of information asymmetry exists in merchant acquiring between the merchant processor and small merchants. So if you look at a company like First Data, profits in their merchant acquiring business are driven almost entirely by small merchants.
Yep.
Are you bearish on the merchant acquiring industry because of that?
I think that the fintech phenomena has had a definitely negative impact, you can already see, on the average spreads in small merchants. This is chiefly Square, but it's also things like Clover that First Data is actively kind of cannibalizing itself in that lane. So yes, I think that what is happening to merchant acquiring, the bad news is that the sort of gouging, the sort of 500 basis points all-in fee that small merchants used to pay has collapsed to more like a normal 260 basis points and will keep going down. The good news is that the merchant acquiring universe, First Data, Global, Vantiv, Elavon, have realized that they're in the software business. And through acquisitions primarily, they have bought up the software that merchants use. The ERP systems of a florist or of a sporting event, the software that they use, and embedded their payment systems in there so that the switching behavior, I think, will die down. So there will be a lower but stable level of spread in the small category for those merchant acquirers that become software enabled. That's my take.
Does it have to be lower if the relationship becomes stickier because the merchant gets invested in all sorts of software? So Clover is a semi-proprietary platform. I don't think that the intent of First Data is to provide lower merchant discount fees with Clover.
Whether it's their intent or not, that's what's going to happen. I think they know that.
Hi. Can you explain how commercial payments are better served by a non-bank than a bank doing, say, a wire transfer? I don't understand the opportunity there for the non-bank versus the bank.
It's the same story as what I just described in merchant payments. The companies growing fastest in the send side of that, so the accounts payable side of that, are all software companies. So we have a company called AvidXchange, not to talk my book, but there are other examples of companies that do, in effect, accounts payable automation. They sell software to the accounts payable department. They move manual paper processes like purchase orders, invoices, approvals, all onto software. And they're in an incredible position to then say, okay, we've already approved all your payments for you. We've posted them to the ERP. Now let us pay them. And let us optimize the mix of that payment between ACH, virtual commercial card, paper check where we have to, theoretically high-value wires, things like that. They do partner with banks to do that. But the accounts payable department is now increasingly loyal to the software vendor with embedded payments than they are to that, sort of JV, cash management banker who shows up and says, hey, how can I solve your problems today? So software is eating payments for sure, and software companies therefore are getting that revenue stream.